Good morning, everyone. Thank you for joining us today. To start with, I have a few housekeeping items to cover, and then I'll do the introduction and we'll get into our presentation. If you have questions while we are presenting, please type them in the Q&A feature at the bottom of your screen. We will be answering your questions at the end of the presentation. If our questions go long, we will stay on to answer them, but please feel free to leave if you have another engagement to get to. This session is being recorded and a link will be sent out to each of you in the next couple of days. I'm Andrea Thermos, a partner in the Boulez Estate and Trust Department. I joined Boulez in 2012 and I was promoted to partner in June of 2021. I have over 20 years of experience in the estate and trust world, with my primary focus on tax compliance and planning as it relates to estate, trusts, and gifts. I serve on the Minnesota Society of CPAs Task Force for the Estate and Personal Financial Planning Conference. And in my free time, I love to experiment with new recipes and entertain friends. Today, I'm joined by Emily Blackburn. She joined Boulez in 2013 and became a partner in June of this year. Her specialties are in trust, estate, and gift tax compliance, comprehensive estate plans, probate and estate administration, including asset management and trust funding. She draws from her education in both accounting and law to be able to provide a variety of services for her clients. In her free time, not that she has any today with two kids, a 2-year-old and a baby, she enjoys all types of outdoor activities with her family and friends. In Boulez Estate and Trust Department, we assist clients in all stages of life. Through our holistic approach to estate and trust planning, we take into consideration the different objectives you have throughout your life when it comes to retirement planning, charitable giving, and caring for loved ones. We strive to develop an estate plan tailored to your objectives, giving you confidence in the future of your estate. This morning, we are going to give you some insights and basics about portability, how it is utilized as part of a long-term plan for a surviving spouse. Emily, take it away.
Thank you, Andrea. So before I get started today, I just wanted to remind everyone that, as with many tax concepts, there are a lot of complexities and nuances. And just due to today's amount of time that we have to dedicate to this presentation, I'm going to try to keep things fairly broad, just to give you the best example possible in understanding how portability works and how it can be used. So won't be able to cover everything today, but as Andrea mentioned, please feel free to ask questions at the end, and we will get to as many of those as possible. All right, so what is portability? It's a way for spouses to take advantage of both of their estate and gift tax exemptions. For 2023, each individual has a lifetime estate and gift tax exemption of $12.92 million. But with portability, the surviving spouse can have transferred to them any unused exemption left over after that first spouse passes away, which essentially is combining then their two estate exemptions. So why would an executor of an estate choose to make this election then? So as I mentioned, 2023, we have a $12.92 million exemption amount, but there can be significant savings by electing portability, especially when, that first spouse to die has an estate valued less than the exemption amount or significantly under that 12.92 current exemption amount. This is allowing the surviving spouse then to pass on even more assets tax-free when they should pass away. You're going to see this becomes especially important in the next few years. If there isn't new legislation passed, the current exemption amount is scheduled to sunset at the end of 2025, starting on January 1st, 2026, back down to $5 million indexed for inflation. So let's take a look at some examples and you can see how this could play out in a couple of different scenarios. So we're going to assume Jack and Jill are married. They're both US citizens. Jack dies 2023 with an estate value on his own of $8 million. And then we're also going to assume that Jill's estate is worth $8 million on her own before inheriting anything from Jack. We're also going to go with the assumption that Jack's estate plan is just leaving everything to Jill upon his death. No charitable organizations or anything like that. And final assumption is that neither Jack nor Jill have already used any of their exemption amount during life with any lifetime gifting. So for this first scenario, let's assume that Jill dies in 2024. So the IRS has updated the 2024 exemption amount. It's 13.61 million, but for our purposes, we're just going to round that to 13 million today. And we're going to assume that Jill, after Jack passes away, and then once Jill passes away, everything is going to be transferred to their children. So on Jack's death, remember he died in 2023, there's not going to be any tax due because everything according to Jack's estate plan is passing to Jill and is qualifying for a marital deduction that allows spouses to leave things to each other tax-free for estate tax purposes. So, we're looking good on Jack's death, right? But now on Jill's death, without electing portability when Jack died, we have Jill with a total estate value of $16 million. This is because she had $8 million, and then she also inherited Jack's $8 million. Again, we're assuming no growth, appreciation, anything like that. So just nice round numbers here. So in that scenario, without electing portability on Jack's death, $16 million estate, she can subtract her own exemption amount, and that's going to get her down to the taxable value of 3 million. So 16 minus that 13 million assumed exemption leaves us with $3 million taxable estate value. And just utilizing the tax rates currently in place, that puts us at about $1.1 million due in estate tax. So you can see that's kind of taking, a fairly large chunk away from her kids' inheritance. However, if we use portability, if it was elected when Jack passed away, and we're using those same values, what happens then is Jill is left with not only her 13 million exemption, she also has an additional 4.92 from Jack's death because he only needed $8 million of his exemption when he passed away. And that's assuming, I think I said initially everything was passing to, so that's my mistake. I said everything was passing to Jill outright with the marital deduction. That's assuming he used $8 million on his death to transfer to anyone besides charity or a marital deduction. So that's a mistake that I misspoke. So sorry about that. But we're assuming he had 4.92 million after his death that he didn't use. And so we're going to then be able to apply that to Jill's estate. And now she has no taxable estate whatsoever. She's got plenty to cover her 16 million. And overall, our savings then by using portability is 1.1 million. So that's great. You look at what could happen in 2026. Again, we're assuming here now, this is after the sunset provision, right? So assuming no legislation has passed for any new estate tax exemption amount. They think it's going to be around $6 million. It's really 5 million indexed for inflation, so we don't know for sure what it would be, but we can assume probably in the ballpark somewhere of $6 million. So again, no tax due on Jack's death, as either all of his exemption was applied to what was passing to non-marital or charitable beneficiaries, or anything passing to Jill qualifies for that marital deduction. So just a little caveat there for me to add. But again, so now without portability, let's look at what happens here in 2026 after that sunset has taken place. So again, Jill's estate is worth, we're saying 16 million. Using her exemption of 6 million to apply to her estate, we're left with a value of $10 million. And then that leaves almost $4 million of estate taxes due, which that's a huge jump, right? So if we then look at how portability can really help us out here, again, we are able to use anything that Jack didn't need on his death and transfer it over to Jill. So she's got an extra 4.92, we'll say. Estate, again, worth 16. Subtract out her 6 million exemption from 2026, plus the amount that she received from Jack on his death. And now we're left with a taxable estate for Jill of about $5 million, and owing almost 2 million in estate tax. But now portability is saving us almost $2 million. So we've really kind of doubled our savings here. So you can see in both scenarios, though, 2024, prior to the sunset and after the sunset, we've got a significant amount of savings, and it really can be a huge benefit depending on, you know, who the beneficiaries are, the estate size, just the specific facts of that couple's kind of estate planning and everything. So now that we've seen kind of what savings these portability provisions can provide, let's see how we can make that election. So the executor, or personal representative, as it's known here in Minnesota, of an estate must elect the portability of what's known as the deceased spousal unused exclusion, or DSU, some of you may have heard it referred to as, on a timely filed estate tax return, Form 706. And we'll talk about kind of what, you know, meets the criteria for timely filed in a little bit. Otherwise, you can also, along with electing it on the timely filed estate tax return, there is a simplified reporting method available for those estates that wouldn't have a filing requirement if not for, you know, wanting to elect this portability. So, for example, in this scenario, Jack died with only $8 million of value. He doesn't necessarily have a filing requirement because his estate isn't above that federal exemption amount. But we still want to elect portability. And so the IRS has come up with a way to allow for a simplified reporting so that, you know, we don't have to spend quite as much time. It's still kind of a process, but any of you that have had experiences with estate tax return filings, you can, you're aware that they can be very intrusive. It can be kind of a long process. There are a lot of disclosures that happen. A lot of information is provided in these returns. So it's not a return that a lot of people are probably used to. And it's unlike your normal kind of income tax return that you file each year. So there is a simplified reporting method available. And in this method, it allows us to essentially estimate some of the values of assets that are passing to either charitable or marital, you know, surviving spouse. So it allows us to have a little bit of a less intensive kind of preparation process, but you are still required to file that return. And then Andrea, I will pass it off to you.
Thank you, Emily. So Emily mentioned on the previous slide that this election needs to be made on a timely filed return. And unlike income tax returns that have a set, you know, your 1040 is due on April 15th. Everybody knows that. 706s, which is an estate tax return, are due 9 months after date of death, and they're due 9 months to the day after date of death. So a timely filed return for somebody, let's say, that passed away today, that return would be due on August 7th of 2024. Extensions are allowed for this. And if an extension is made, that would extend the deadline out to March 7th of 2025. So you can see that this can be a long process. In Emily's examples, she didn't factor in Minnesota, and we have nuances and things that we can cover in assisting with Minnesota taxable estate that does not have a federal requirement. And that's part of the planning that we can help you with. So is there relief? So what happens if, in Emily's example, she talked about 2024 versus a 2026 death? And sometimes a personal representative may make a decision not to make this election. And if the election isn't made on a timely filed return, and we hit that sunset and discover that we're in Jill's shoes and she has a $16 million estate that she now would like to use portability on. Well, thankfully, Emily did an example that was less than a 5-year span of time. And we could make an election. The IRS has a provision that allows a personal representative to file a Form 706 within 5 years of a deceased spouse's death, with this notation on the top of the file, filed pursuant to Rev Proc 2022-23 to elect portability under Internal Revenue Code section 2010, et cetera. And we put that at the top of the 706. So in Jill's case in 2026, if the portability election had not been made at Jack's death, we still would have the opportunity to file a late filed return for Jack to make the portability election. Then we could still utilize his portability on Jill's subsequent return. And it would still put them in that better situation of knowing that they were able to utilize Jack's exemption along with Jill's. Emily covered this, but how was the election not made? So Emily talked about how the election is made, how it's not made. Simply not filing an estate tax return will put you in a situation of not having made the election, but also affirmatively stating on the return that you're not electing portability. And in what situation you might have a second marriage in which they have their own children, they have their own issues, they have their own estates that they want to take care of. And that would be the reason why you probably wouldn't make the portability election. Hopefully in those situations, the couple is doing planning and they're working together so that each of their personal representatives will know what they want to happen on their respective estates. Otherwise, I don't know. Here in Minnesota, because of the difference between the federal and the Minnesota exemption amounts, we often complete a federal return for the first spouse to die. And because we complete that federal return to file the Minnesota return, we automatically make the exemption, the portability election, because it just makes sense. We don't know what the future is going to look like. We don't know what Congress is going to do with the sunset, if they're going to do anything. We don't know if the exemption is going to go down. We don't know, unfortunately, crystal balls don't work these days. And we really are kind of at the mercy of Congress on what that might look like in the future. So back to Minnesota briefly. Minnesota does not currently have a portability election available. So that's one of the other techniques that we take into consideration. We, like I said, when we filed the first spouse's 706, we always, I'm not even going to say often, unless a personal representative were highly against it, we always make the election on the first spouse's death, because it just makes economic sense. If Minnesota changes their law, that will change our planning in the future, but there is not any legislation in place, and I'm not aware of any active, it's talked about, but they don't have any active bills in place for Minnesota. So it's a great.
There was, Andrea, something presented, but it hasn't moved past that.
Right, it hasn't moved past. Yeah,
as you're alluding to. Mm-hmm.
You're right. So we are hopeful that Minnesota will get on board, but again, their exemption amount is about, at this point, about 10 million less than it is for federal purposes. So there's still a big gap there, and there is lots of planning that should be done ahead of time. So the only states that I'm aware of that have a portability are Hawaii and Maryland. And I don't know that Hawaii actually has an estate filing requirement. I don't remember which states. So that is all we have to say about portability. We would love to field any questions if anybody has any questions about anything. I would like to thank each of you for joining us today and hope that you got some nuggets out of the information provided. If you would like assistance determining the best plan for your specific situation, we are here to help. This session was recorded and a link will be sent out to each of you in the next few days. Emily or I can be reached through the links provided on the screen, and we will stay on to answer any additional questions or answer any questions if anybody has anything. Thank you very much.
Okay, we have a question here. So in Minnesota, they're asking if spouses need to have some assets individually instead of titled jointly to use that exemption amount on the first death. Do you want me to take that, Andrea, or do you want to?
Go ahead.
Okay. So the way it works is, for ease of my examples, I just had everything split. When we do the estate tax returns, joint assets for valuation on the return are split essentially 50%. So that doesn't necessarily mean you have to have everything titled separately. I will say titling matters depending on your estate plan, though. You know, if you have a revocable trust or a will in place that has tax planning built into it, has, you know, certain trust structures built into it, you don't necessarily want everything titled jointly because it's going to pass automatically on death to that surviving spouse then if it's titled jointly. And in some instances, that's absolutely what you want. If that was, you know, an affirmative kind of position as a part of your estate plan. But that may not be what you want if you've taken the time to go through and kind of do some of these tax planning strategies within your estate plan. Assets titled jointly do not pass under your will or your revocable trust. They're known as non-probate assets.
Something to add on how to title assets. I've seen a recent surgence of people doing transfer on death titling, and be aware that if you owe taxes and you've transferred everything, you're going to have to ask the beneficiaries for money back. So be cautious. While transfer on death is a great planning technique if you don't have a large estate, if you're at that cusp of around the 6 million mark, well, for Minnesota purposes, if you're around 3 million, your estate might owe Minnesota estate taxes. And if you transfer everything, the beneficiaries are going to be subject to paying those taxes out of the money that transferred to them. And then we have, someone's asking if we can provide a link to the form for filing the 706 requirement for electing portability. Hey, Valerie, can we make sure to include that in the follow-up email? So we'll do that. We'll include it in our follow-up email.
Yeah.
With the recording. And I think that's all the questions we have. Again, thank you all for joining us. If you have a specific situation that you would like assistance with, either Emily or I would be happy to help you with that or answer any questions that you might have. Thank you and have a wonderful, wonderful day.